Hello, I'm Peter Quinn with Cater Matthews in San Diego, California, and today I'm joined by Gary London. Gary is the founder and principal at London Motor Advisors. He is an advisor to every big, successful real estate company, developer, brokerage, investors across the United States. Certainly a real great resource for those of us who are lucky enough to live in San Diego. Gary, welcome today.
Thanks, Peter. You're making me sound old.
We both resemble that remark. So, I guess if with your permission, I'd just like to jump into a summary of what the first half of this decade looks like or looked like to you.
Well, I mean, I think everything circles back to the circumstances we're living in right now under the Trump administration. And I participate in a local column in the San Diego Union Tribune called The Econometer, and they asked us for what was the one economic indicator we would look at in the coming year. And I couldn't think of a single economic indicator that would be guide me to be indicative of what the future, what the prospects are for our economy in the coming year. So the word I settled on, which I incidentally did last year as well, was chaos. This year was chaos part two, because there's so much uncertainty in the economy right now. I mean, just name your culprit, starting with tariffs and all that's going on in terms of world events, domestic uncertainty. Now the fact that the Fed chair is under investigation. I mean, the list goes on and on. So it's really just completely difficult to calibrate the prospects for the economy, which ultimately translates to caution and conservatism on the part of business people. In other words, it's difficult to make decisions in a chaotic environment. And it's no different in the real estate world than it is in the manufacturing world. There's just so much uncertainty here that any kind of prediction that we might make will probably get laid to rest next week. So I think that
Nature of the business, huh?
yeah. I think we can be hopeful that this is a resilient, large, diversified economy, and things will settle down. But then again, this is an election year coming up, so there's certain to be a ratcheting up of the various political debates, economy being in the forefront. So we'll see. And it's just one of the most difficult environments to operate in for any business, uh, certainly in a couple of generations.
Any safe havens nationally?
Well, I think that there's nothing that strikes me as particularly unsafe. I mean, I feel that the stock market is bubbling up. It just can't be, we just can't have an AI driven stock market bubble forever. Something has to break. This
Agreed.
concept of a K-shaped economy defined by haves and have-nots, that's not a sustainable situation. But scarcity in the real estate sector, particularly the residential sector, sort of creates some kind of sanctity, at least preservation of value in our assets. So that's the one thing that I sort of focus on right now.
Let's draw that lens in a little bit closer and just look at 2025. Any big stories out of 2025 you can reference, or what was the overall result
In terms of the national economy,
nationally, California, San Diego?
well, I would say that things didn't break. Unemployment is slightly higher. Stock market is much higher. Real estate values seem to be stable, maybe going down a little bit, which isn't necessarily a terrible thing. Um, and that's true of California. It's true of San Diego. It's true of the nation right now. Um, I think that what's taxing all of us is fiscal budgets, locally, statewide, certainly nationally. The failure to make decisions about our national debt is probably something that ought to be in the headlines but isn't, and that's been bendable for a while. Maybe we're getting close to having to make some decisions about that breaking. Uh, and that's true of city budgets as well. So I think those are things that I would look at right now.
I'm actually more concerned about the local economies. I am very concerned about what's going on in San Diego. Article in the paper today about water rates going up, as much as 90% over the next 2 or 3 years. That's like crazy. And it feels to me, in some ways, as if things like that, and it's not just the city, but it's the county and it's the state, are manufacturing crises by passing legislation which essentially agrees to fund uh, things in our economies that don't have the the tail necessary to produce the funding. I mean, you can't keep raising wages and adding personnel and not expect that taxes are going to go way up, which nobody seems to want to do. I certainly don't want my taxes to go up, but um, yeah, there appears to be no adult in the room in any of those venues.
Well, taxes are a big issue. None of us want to see our taxes raised, and there's movements afoot to raise not only water rates but sales taxes, property taxes, transaction taxes in the real estate area. These are all concerns. My biggest concern relates to population movement and demographics. In San Diego, in particular, this is the first time over the last few years since the post-World War II generation that San Diego is seeing both first a stabilization and a prospective decline in its population. And that to me ought to be the center of attention regionally in terms of what our policymakers should be pointing to right now. I mean, essentially what has happened is whether it's taxes or just general cost of living in the coastal regions, not just San Diego, but this story can be told the same going up and down the coast. People are moving out, and when people start moving out on a net basis, that does not bode well for regional economies. And the only and what I should say this: what drives the population figures are natural increase, which is down. In other words, less babies being born per household. We're under the replenishment levels now, nationally and locally. Immigration is, for all the reasons that are obvious to everybody, is way down. So we're not replenishing our population through immigration. And the one thing that we can sort of address in terms of local policy making, which is cost of living in San Diego, is not being properly addressed. And what it's resulting in is particularly the demographic of young families or people that are young and want to raise families moving out of San Diego and not enough people replacing them moving in. And that is a cost of living issue. That's a cost of living issue. And the biggest part of the cost of living in San Diego is housing costs. And that housing costs are driven by scarcity. Not enough housing is being built. What is being built, what does exist gets bid up, whether it's rent or sale prices. And that is my biggest economic concern in San Diego, because you can draw a straight line between the sustenance of companies in every sector and what's going on in the housing sector. And it's the same story. Companies cannot sustain their employment or bring in new employees because people can't afford to be in San Diego anymore, particularly if they're just starting out or they're in the most early impressionable stages of their careers. And that to me is the biggest driving force in our economy right now, in our region, politically, economically, that needs to be cured.
So we should have spent $12 billion on a bullet train to Ocotillo, built thousands of homes out there, and gotten a labor force able to get to San Diego, Riverside, Orange County, and LA via high-speed rail, and feed them breakfast on the way out and a cocktail on the way home.
Yeah, I hadn't heard that solution, but I thought you were going in a different direction with that comment because I'm not a big believer in rail, high speed or otherwise in Southern California, and I don't think
Me
that's
neither.
the, I know you're not, and I don't think that's the solution to anything. I will say this, there's a lot of ineptitude going on both state and locally in terms of housing policy, but at least our policymakers have been focusing on housing policies. And I'll even go a step further. The San Diego City Council and the mayor's office have been the most housing friendly group of policymakers that I've ever seen since I started my career, 5 decades ago in this region. The problem is that we're so far behind the eight ball in terms of housing. And then you couple that with homelessness and affordability. That's really difficult on a local basis to for them to address the housing issues. And we just are way behind in our ability to supply new housing, which is what is causing all these issues, which I think are ultimately rippling through our economy. I'll go a step further. The San Diego Chamber of Commerce, Regional Chamber of Commerce, hired my firm a few years ago to do a study on housing, regional housing. And as part of that study, we interviewed CEOs and owners of companies in throughout the San Diego region. We did survey research. And one of the questions, the main question, in fact, that we asked them is the survey research version of what keeps you up at night. And the answer always, 100%, was our inability to retain our employees or to attract new employees. And that's not a dotted line or a slash line. That's a direct line to housing issues. And that's really what I'm really focused on right now. And there's some, essentially there's sort of a disconnect between businesses and housing, but there ought to be a connecting linkage between the two. The City of San Diego School District, for instance, is looking at proposals right now. They solicited proposals from development teams to select builders to build housing on obsolete city school sites for the purpose, I presume, of housing teachers and their staff employees to give them alternatives to stay in town and to sustain an employment base for the school district. That's the sort of thing that employers need to get involved in as well. And we've sort of ignored that relationship between where we work, how we work, and where we live. We tend to treat housing policy as sort of a separate thing. And then what happens there is then you invite resistance in the neighborhoods, and very few people understand the connecting tissue between employment, regional economy, and housing. And we just haven't got a handle on that in this region. And I fear it for it because one of the there's a couple negative things that can come out of that. One is worst case scenario, we could become Detroit, which basically saw its economic base collapse with being a one industry town, automobiles, when that industry collapsed. And this is true of many of the Rust Belt cities, Cleveland, Toledo, name your poison. Or the other alternative, we could become a boutique economy, kind of like Santa Barbara, where
Right.
if it's a small town, but essentially their basic employment base comes from out of town into Santa Barbara every day from places like Ventura. And in fact, they're expanding their freeway system in town right now to accommodate the horrendous traffic that causes. And in San Diego, you can sort of see that. If you go up the I-15 corridor from San Diego to Riverside County, it's stuffed with 47,000 vehicles a day going back and forth. I mean, it's a nightmare, and that's all owed to the fact that if you haven't moved out of the state already, you've moved to Riverside, but you still have your job in San Diego. So you choose the stress of commuting so that you can afford a house to raise your family in at a more affordable location, which is Riverside. So there's all kinds of sort of versions of this discussion that we can have, but this really is the big economic issue that we face in this region. It's all about housing.
What's going to be the big story, housing aside? And I know that housing is connected to maybe the big
Yeah.
story that we can look forward to in 2026.
Well, I mean, obviously, the continuation of the bleed of the commercial office market is kind of a big deal. We're facing, particularly in the CBD, the Central Business District of San Diego, but not very different from other central business districts around the country, just record high vacancy rates, and that's translated into building office buildings being sold at about 30 cents on the dollar of their former value. Ultimately, the good news that might translate into lower lease rates, but the demand base is greatly diminished with, with some exceptions. I mean, I guess Chase just built a brand new office building in downtown Manhattan, but you don't see much like that. What you really see amongst law firms and professional service firms in particular is a compression of their office space requirements because more people are working at home or in their ADUs, if not full-time, part-time. There's a lot of hoteling going on in the commercial office sector. People are compressing their demand, which is what has caused this vacancy. In downtown San Diego, the reported vacancies are just under 30%, which is a huge number, but I believe the number really is closer to 50%
Yeah,
when
I
you
agree.
add in sublease space and so forth. And so what's happened is that buildings have sold at a fraction of their former price. Irvine just basically vacated the buildings that they owned in downtown San Diego, and other people have picked up those buildings at these discounted prices. And they have basically three things they can do with these buildings. They can sort of keep them on the market for a fraction of the lease rates. And to that point, lease rates in Class A space in downtown San Diego, which were starting to hover at their peak at close to $6 a square feet or closer to $2.50 a square feet. Class A space renting for what formerly was B and C rents. So you have that. The second thing that they can do is convert some of that space to other things. But there's very few other things you can do. And a lot of these buildings aren't particularly convertible, at least not easily convertible, say, to residential. So, but there's some of that going on. And the thing they can do is demolish. And, we'll see probably some of that as well. But in downtown San Diego, there's well over 12 million square feet of maybe like more like 14 million square feet of office space. And to think about half of that is empty is a pretty sobering thing. So that's a big issue that continues to bleed into 2026. And then I guess I have to go back to the residential market. I mean, the big story there is we're probably going to see a stabilization in pricing in the residential sector because there's just not a lot of transactions going on. We are seeing some drop in takeout rates, 30-year takeout rates, but
Right.
there's a kind of a psychological barrier there because the drop is from like higher 6% levels to just around 6%, which isn't quite enough to change minds of people who basically have decided to stay in place with their 3% loans that they got during COVID, the post-COVID period, or 3 or 4% loans. So there's
Gary,
a,
what do you think about the portability of loans? What do you think of that idea?
I love that idea. As a matter of fact, I wish that instead of the Trump administration focusing as they seem to be today, focusing on eliminating the institutionalization of housing. In other words, the purchase by large funding groups, we all know who they are, of single family housing re-renting. To me, that's just a really small part of our market and of most markets. What they ought to be focusing on is eliminating the capital gains taxes or greatly reducing them, particularly for senior citizens who are overhoused. So a lot of people, I don't want to put us in that category quite, Peter, but there's a lot of empty nesters out there that have much larger homes than they need anymore because their families are gone. But they're stuck in place,
Right.
partly because the loans they refinance, but also because they have huge capital gains that they have to pay. And when they move into a new house, they even if the house is cheaper, they have much higher property taxes to pay because the bases are higher. So the third part of that solution is to pass through the old property tax rates as well. And then you'd actually raise revenues from a state and local perspective because you have more transactions going on. So these are
Right.
things that I think would instantaneously cure what is a moribund resale industry right now. When you couple that with the potential to add new housing development, which is a topic we can get into, then you got something going here. But this idea, you're sort of biting around the edges when you're talking about things like eliminating institutional purchase of single family homes or extending the 30-year mortgage to 50 years. I mean, these are kind of dumb ideas and they're not going
Yeah.
to move the needle at all.
All right. So quick lightning round here. Score 1 to 10, 10 being fantastic, one being uh-oh. Industrial.
So, well, it depends what you mean by industrial. I mean, in San Diego, I'm sorry, I'm not going to score. I got to explain first. In San Diego, industrial isn't really industrial. It's warehousing space, um, and and related technology space, data centers, that sort of thing. It's not really people building things anymore. But that's pretty strong. I'd say that's probably my highest rating category. Give it an 8.
Retail.
Retail is actually pretty good. It went through its sort of compression stage during COVID and post COVID. A lot of people in the shopping centers. We've changed a lot of shopping centers from exclusively retail to mixed use centers. We've You can see in San Diego, for instance, Mission Valley Center is going to add a bunch of housing units. Fashion Valley is. We're looking at Grossmont Center eventually, maybe. North County Fair eventually, maybe. We're seeing a lot of trends in smaller centers too. So I would say retail is pretty good shape right now. I'd say I give it a 6.
Um, Office, I think you've already commented on. We're probably in the, yeah, less than
0 to 1.
one.
It's going to take some time for the office market to correct itself. I focused on the CBD, but we're seeing weaknesses across the board. I mean, we're seeing the weakness, for instance, in the technology sectors and the bioscience sectors. They're all struggling a little bit right now as well. So we're seeing weaknesses in the markets that they reside in, which are typically more suburban markets. But
Yeah.
some markets are strong. I mean, if you go to Carmel Valley, if you go to UTC, some of the Scripps I-15 corridor, these are markets that are strong. So it's a mixed bag.
Yeah. No, I
So
agree.
because it's a mixed bag, we'll give it a 3.
Apartments.
Apartments, we just finished a big apartment regional study, and that's a tale of sort of two cities. The older stock of apartments that are typically resident in suburban markets or outside of the big urban markets like downtown Mission Valley, UTC, they're holding pretty steady. Occupancies are still hovering around 95%, and rents are pretty stable. They're not going up much, but they're pretty stable. When you get the other part of the story is when you get into the big urban markets where you see a lot of vertical high rises that have been built, like downtown San Diego again, that are more in the luxury class. You're seeing a
Right.
lot of slippage of rents. Vacancies are at least 5 points higher, and lease rates are slipping to the extent we're seeing a lot of deals, 3 months rent at the front end for a
Yeah,
few months and that
exactly.
sort of thing. So there's definitely an oversupply of luxury or quasi-luxury rental right now, and that's what's going to define 2026. We're going to see a correction in the in that segment of the apartment sector.
When I met you probably 35 years ago, both raising our young families in North County, single family residential was popping up everywhere. There was land everywhere.
Right.
And it is very difficult to find green pastures where housing can be built today. It just doesn't exist in most, certainly in coastal markets.
Well, it doesn't exist in the coastal market because they're built out, and so we're talking infill there. But it does exist. The problem is that my developer clients don't have access to it. Most of it's in unincorporated San Diego, and there's a ton of land that is prospectively developable that you can make a case that it ought to be developed because it's near freeways and job centers or has access to it. But because it's in the unincorporated area, and because we don't have the same quality level of policy making in the county as we do in the city, they're not housing centric. In the board of supervisors are not. That's part of the problem. We're just not getting housing built. And so that sort of skews the supply demand balance. In other words, the markets are out of balance because we're not building new homes, which then bids up the price of existing homes, both on the coast and elsewhere. And then that coupled with what we were chatting about earlier, which is just the lack of sort of resale activity, uh, creates an additional sort of a hyper bid up a period for housing. Having said that, I don't see, I think we're in a place where housing prices are probably going to be pretty stable, if not slightly down over this coming year, because demand is down for reasons that we've lack of affordability and people and out migration, people moving out. But if we're really going to address housing, we need to address family housing, and there's two ways to address that. One is to open up these unincorporated areas to housing, which is a very complicated conversation to have because lots of legislation, state and local, gets in the way. And the other is infill development, which we've been working on. I've actually created a couple of reports, which the mayor's office is very interested in, and we're moving towards, I think, public policy where we will change zoning by allowing higher density housing in single family neighborhoods, meaning townhomes and row homes, which allows enough density so we sort of take out the land component, which is the biggest component of the cost of a house, and bring the cost of the house down. As a matter of fact, if one of my studies, my key study, suggested that if we take a single family lot, tear down the home on that lot, and we studied this over 9 neighborhoods in San Diego. We replaced it with that one home on that one lot with 4 or 5 townhomes. We would reduce the price of those homes by 42% relative to the price of the house that was there before that, which brings housing for families attainable to them. And that's something that I think the city of San Diego is going to implement at some level this coming year. So I'm hopeful that that's one solution. But even if we do that, we still have to build housing on green fields in the unincorporated area to really tackle the housing problem in a way that it ought to be addressed.
I'm never disappointed when I get a chance to sit down with you, Gary. I appreciate you joining me here today. And for those of you who have an opportunity to watch this podcast, Gary will be speaking at a Rotary Club civic event near you soon. So please look out for him. And at the end of this video, we'll post all of Gary's contact information. Again, he's a spectacular resource for me and my clients. And I'll look forward to spending more time with you in 2026.
Thanks for that, Peter. I'll look forward to it as well. Take care.
Thank you. This is Peter Quinn with Kidder Matthews in San Diego, wishing you a successful 2026.